So, September 2nd, what a wild day for the global markets. At first glance, all the activity looked pretty disconnected, right? But it turns out it was all deeply intertwined. Today, we're going to break down the powerful forces that collided that day to create a true perfect storm in the world of finance. So, yeah, the big question is, what really drove the markets on September 2nd? You had this historic first happening in India, then this dreaded historical pattern showing up in the US, and on top of all that, just a storm of global news. Let's peel back the layers and see exactly how these three forces cooked up this perfect storm. Okay, so let's start in India, because that's really where the first spark happened. We're talking about a fundamental change to the market's very plumbing, a change that set the stage for everything else. For the first time ever, Tuesday was about to become the most important day of the week. Yeah, Tuesday. All right, first, a super quick primer on derivatives expiry. Basically, think of it as the use-by date for certain financial contracts, like options. These days are notorious for high volume and big price swings, as traders are all scrambling to close out their positions. Now, here's the key. For decades in India, the main event, the big expiry day, was always Thursday. Well, that just changed. The change itself was simple but profound. The two major Indian exchanges, the NSE and the BSE, they literally just swapped their expiry days. This meant that on September 2nd, for the very first time, the massive National Stock Exchange had its weekly derivatives expiry on a Tuesday. And look, this wasn't just some tiny tweak. This was a seismic shift in the market's mechanics. And what happened right away? A huge spike in volatility. India's main index, the Nifty 50, swung in a massive 234-point range. I mean, that is a level of choppiness the market hadn't seen in weeks, and it was a direct consequence of this new expiry schedule. But wait, here's where the story gets really interesting. Because even as the main Nifty index was down, some parts of the market were absolutely flying. Consumer goods were up over 1%. Consumer durables up over 2%. So what gives? Well, it was all about hopes of a tax cut in an upcoming government meeting. This just shows you we had this wild volatility from the expiry change, but also this massive divergence driven by completely different sector-specific news. Okay, so that was the local spark in India. But at the exact same time, a much older and more predictable pattern was taking hold over in the United States, a kind of historical headwind that, frankly, every trader knows to watch for. It's called the September effect, and it's pretty much exactly what it sounds like. For reasons people still debate, September has historically just been the absolute worst month for the stock market. Get this, it's the only month that on average posts a negative return. It's like this ghost that haunts the market every single year. You might be thinking, is this for real? Well, let's just look at the numbers. Since 1928, we're talking nearly a century of data here. The average return for the S&P 500 in September is negative 1.2%. And it's not just a fluke average either. It's remarkably consistent. More than half the time, 55% of all Septembers, the S&P 500 has finished in the red. It's like flipping a coin that's just weighted against you. And hey, this isn't some dusty old pattern we're talking about. It's been incredibly relevant lately, with 4 of the last 5 Septembers ending in the negative. So you can see why traders were coming into this month already on high alert. But here's what's so fascinating. This whole effect plays out differently around the world. While the S&P 500 in the US clearly has that negative bias, India's Nifty 50 actually averages a positive return in September. For them, the key characteristic isn't poor returns, it's high volatility. It's a great reminder that while seasonal trends exist, they don't play out the same way everywhere. Okay, so we've got our first 2 ingredients, the spark in India, the historical pattern in the US. Now let's add the third element, a sudden, intense storm of market-moving news coming from all over the globe, all hitting at once. And man, the headlines were just relentless. A US court suddenly struck down Trump-era tariffs, throwing global trade into question. The US also revoked key waivers for chip makers in China, disrupting the semiconductor supply chain. An activist investor took a massive stake in PepsiCo. Oh, and fears over the UK's finances sent their bond yields to levels not seen since 1998, sparking a wider sell-off in global bonds. It was just a total barrage. And look, it wasn't any single one of these stories that mattered. As the source material highlights, it was the convergence of all these different narratives that created this powerful risk-off mood. Basically, with trouble popping up on multiple fronts, investors started pulling back, which only amplified the already fragile sentiment of September. And it's not like this uncertainty was going to clear up overnight. Investors were staring down a calendar packed with risk. A key tax meeting in India, a huge interest rate decision from the US Federal Reserve, and the final deadline for the tariff appeal. With so much on the horizon, it's no wonder caution was winning out over courage. All right, so let's bring it all together. We had the spark from that structural change, the pattern of historical seasonality, and the storm of global news. So, what's the big takeaway from this massive collision of forces? Yeah, when you lay it all out, the picture becomes crystal clear. September 2nd wasn't just chaotic because of any one thing. It was a perfect storm. A specific local event in India collided with a broad historical pattern, and the entire situation was supercharged by a blast of global news. Each element just made the others that much worse. So, how do you even navigate an environment like this? The analysis points to a three-part strategy. First, moderate your position sizes. This is not the time for huge bets. Second, focus on finding opportunities within the market through what's called sector rotation. And third, above all, make risk management your top priority. The game shifts from chasing gains to preserving capital. And all of this leads to a really fascinating final thought. In an environment where the very rules of the market are shifting, while at the same time these old historical patterns continue to echo, is caution the new courage? It's definitely something to consider as we watch these powerful forces continue to shape our markets.